Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at two companies that some of Wall Street's top performing analysts believe are a buy during a market downturn. This article published by CNBC outlines 5 different companies that some of the top performing analysts on the street believe are a buy at their current price point. So I went through all 5 companies listed in the article and determined which 2 I believe are the best fit for investors at their current share price and which companies provide the greatest value and upside over the upcoming years. So we're going to take a look at the 2 companies I selected in this video, do an overview of the company's operations, and take a look at their recent financial performance. But before we jump into that first stock, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and on this channel we talk about the stock market, go over any major market news, and we track the progress of my personal stock portfolio that is now at a value of $165,000. So if you're into investing content, please hit that like button and subscribe. And now we're going to move right in to the first company listed in this article on CNBC, and that is ticker NVDA for NVIDIA. The major semiconductor company that's taken a beating over the past few years is now considered a buy from Wall Street's top performing analysts. So after their latest quarter, they believe the company is getting back on track and is soon to continue to go back to growing at a rapid rate. And they actually increased their price target from $180 up to $185 per share. These analysts are also forecasting that 3 of NVIDIA's main business segments, which include the auto industry, data centers, professional visualization, and gaming, are projected to grow at a rate 3 times faster than the overall semiconductor market, which is a fantastic sign for potential NVIDIA investors. And now if we take a look at the company's stock chart, they currently trade for $156 per share. They've taken an absolute beating over the past 12 months and are now down over 53% on the 1-year chart. They currently sit at a market cap of over $400 billion and are trading with a relatively high forward PE ratio of 48.4. So although the company still trades with a high PE ratio, if we take a look at the Morningstar report for NVIDIA, they believe the estimated fair value per share for this company is at $217, meaning the current share price right around $160 is projected to be at a 25% discount of the company's true estimated fair value. So right now you can pick up NVIDIA at a discount, according to Morningstar, by around 25%, which is why I believe the company now sitting at a buy rating from most of the analysts on Wall Street. I think the company has fallen too hard, too fast, and right around the market is now projecting some growth from the name over the next few years. And if we take a look at their investor presentation, NVIDIA believes that their current market opportunity is valued at over $1 trillion. And the company has done an incredible job of continuously expanding their market share year after year in each of the 5 respective industries that make up their potential $1 trillion of opportunity. And how the company generates their revenue currently comes from 4 main business segments that generate 96% of the total revenue for the company. First is their gaming segment, which generated 46% of the total sales in fiscal year 2022, bringing in over $12.5 billion to their top line, and that's been growing at a CAGR of 25% over the past 5 years, so very consistent growth from the gaming industry. Next, we have their data center, which generates 40% of the total revenue, coming in at $10.6 billion, and that's been growing at an absolute massive CAGR of 66% over the past 5 years, and analysts believe this data center revenue can continue to grow at over 50% for the next 3 to 5 years going forward, which will be a major revenue driver for the business over the upcoming years. Then we have professional visualization, making up an only 8% stake of the total top line, coming in at $2.1 billion. That's been growing at a CAGR of 20%. And then, of course, the smallest contributor to the company's total revenue is the automobile industry, making up only 2% of their total sales. And this segment generated only $600 million of revenue during the past year and has been growing at a slight CAGR of only 3%. So not really any growth coming from this industry over the past 5 years, but going forward as more electric vehicles are produced, sold, and are being driven on the roads, NVIDIA believes the demand for their chips and processors for the automobile industry will continue to grow at a rapid rate going forward, and this CAGR is projected to hit over 10% during 2024 and onwards for the company going forward, which is a great sign. And now if we take a look at their 2 largest revenue generating segments in more detail, starting with the data centers, we can see the company is projecting that the exponential growth in this segment's revenue is going to continue into fiscal year 2023, and in the first 6 months of the next year alone, they're projected to generate over $7.5 billion of total sales, a massive growth over the prior year. And as well, it's great to note that 357 of the top 500 supercomputers in the world are powered using NVIDIA chips and processors. That just shows how much of a market share they have in the data center industry and how reliable and durable NVIDIA chips are in practice and in everyday use. And then, of course, if we take a look at the gaming industry, they're the world's largest gaming platform. They have the #1 market share in this industry with over an 80% share of the market, and they currently have 15 of the top 15 most popular GPUs on Steam, which is an incredible feat. They are the top 15. So overall, this company is dominating the gaming industry, which is great to see. And if we take a look, total revenue over the longer term continues to expand. They're generating more and more profits year in and year out. They've done a great job of returning capital to the shareholder by buying back stock over the past quarter, and the company does pay out a very slight dividend that they've grown year in and year out. And now if we take a look at the company's balance sheet, of course we saw sales are growing, they're more profitable, but how's the company's current financial position? They have over $13 billion in cash, and total current assets are over $23 billion. Their total current liabilities sit at only $6.8 billion, so the company's cash alone of over $13 billion can handle all of their current liabilities, and pretty much a quick ratio, if we just take a look at the cash over current debt, that's over 2, so the company is in a very strong position over the next 12 months. And taking a look at the total debt on the balance sheet, it comes in at $19 billion, and with the company having $13 billion of cash on hand and $19 billion of total liabilities for the entire business, I feel very confident in their ability to pay off all this debt going forward, and I do not believe they're going to go through any financial hardship over the next short or medium term. And then of course now if we take a look at what analysts are forecasting, over the next 12 months, they believe there's over 22% upside in the company's share price from the last close at around $156. So a ton of potential upside at this current point in time. And this 22% projected growth is an average of 40 different Wall Street analysts. And if we take a look, the stock is considered a buy at this current level. 11 strong buys, 21 buys, 12 holds, and only one single sell. So on average, we have a buy rating coming from 45 different analysts on the street right now. So overall, NVIDIA was the first company that was included in the list from some of Wall Street's top performing analysts as a buy at its current share price. It's taken a major dip over the past 12 months and now may be worth doing some research into for your own personal portfolios. So now we're going to continue on into the second stock included in this video, and it is ticker COST for Costco, one of my favorite companies to own. I do have this company in my personal dividend portfolio as well. It currently sits as the 4th largest position. I own 18 shares of Costco with a current market value of over $9,500. So I am putting my money where my mouth is. I am a big believer in this company, and right when I saw it included in this article, I knew I had to feature it in a video. I can never talk enough about Costco. So the company currently trades for $428 per share, and they are down over 5% on the 1-year chart. They have a current market cap at $236 billion and trade with a forward PE ratio above 36. So this company does trade with a premium above the overall market, but you are paying that premium to get such a high quality business. They have a dividend yield at 0.7%, which is nothing too crazy, but the company also does special dividends every few years, so the average rate, including the special dividend, will average around 2% over the longer term. And if we take a look, they're the 3rd largest global retailer, the 11th largest company in the Fortune 500, and like we saw, market cap at around $230 billion. And Costco is so dominant because they have over 65 million households around the world that are members in their business, and over 118 million different individual cardholders currently carry around a Costco card in their wallet. And one thing that shows how reliable this business is that customers keep coming back. The company charges in order to shop at their store, and they still maintain around a 93% renewal rate in North America. That's an absolutely incredible renewal rate. Most businesses that charge a subscription fee on an annual or monthly basis can't maintain over a 70% renewal rate. But Costco is able to do that in a store warehouse type fashion where consumers are paying just to go shop at their stores, which is absolutely incredible. And in the latest 12 months, they generated over $4.2 billion in total membership fees. And if you're unaware of Costco's business model, they're not there to sell you products. Costco really does not make any money on all the goods they sell in their stores. They sell them for very little margin, and that margin covers some of their operating expenses, but the actual bottom line or profit for Costco is the membership fees that they generate. Costco averages around a 2% net margin for their entire fiscal year, and if we take a look, their memberships make up 2% of their total sales. So Costco pretty much only profits off the membership fees, and all the transactions they do, all the goods they buy and sell in their stores, pretty much net to zero after all expenses are taken into consideration. Costco's gross margin sits at around 10 to 11%, and their net income, like we see here, is at only $5 billion in 2021 and $5.8 billion in 2022. So of this $5.8 billion, $4.2 billion of that, or around 80%, came directly from the company's membership fees, and they only made $1 billion in change coming from the actual sales of over $220 billion. And we see over the last year, total revenue has grown rapidly from $192 billion up to $222 in only 1 year's time. And we see over the longer term, this company continues to post incredible results. $141 billion of total sales back in 2018, that continues to grow year after year like clockwork, up to over $226 billion as of the latest quarter. And if we take a look at their balance sheet, this company is run extremely well, and they have a very strong financial position, which is really what attracts me to their business. They have over $11 billion in cash, and their total current assets sit at $32 billion. If we take a look at the long-term debt on the balance sheet, it only comes in at $6.4 billion. So $6.4 billion of total long-term debt for the entire business of Costco, and the company has over $13 billion in cash. I understand they have total current liabilities, but a majority of that is made up in accounts payable. With Costco, because they are such a large vendor, their accounts payable balance isn't really that significant because they have some of the best payment terms in the world. Costco is one of the largest buyers in terms of volume. They demand and they pretty much control the payment terms from all their suppliers. Most businesses receive funds for their products in around 90 days. Costco and one other competitor in Walmart have the ability to not pay their suppliers for 6 months to a year after they receive and sell the product. So I'm never worried about Costco's accounts payable balance. They'll be able to pay that off, I believe, with no issue going forward, and they maintain minimal debt on the balance sheet, which is an absolutely incredible sign. And if we take a look, this is a dividend grower. They began paying a dividend back in 2004 at 40 cents per share, and the dividend currently sits at $3.60 per share per year, so absolute massive expansion over the past 18 years, and we see the CAGR on that dividend is at 13%, and they pay out $1.6 billion annually. And taking a look, the company has over 838 warehouses spread out all around the world. Of course, majority are made up in the United States, Canada, and Mexico, but one growth factor for this business that a lot of investors are not taking into consideration is China. So Costco has begun operating in China just since 2019. Before that, the company had no locations in China, but since they entered that, these 2 locations have been an absolute massive success. Costco's first location in China had to shut down early because the lines were so long. Within 3 days of their first location opening in China, they sold out of a majority of their inventory, and they actually had to close the store in order to restock it. That volume of traffic is absolutely unheard of, even for a company like Costco. So the company currently has 2 stores in China. I believe this country will continue to grow. They have plans to add 7 more additional stores throughout 2025. And I do think going forward, Costco as a whole in China can become a major division for this business. I think that's going to be a major growth driver that can put them to the next level overall and can help them actually become one of the world's largest international retailers overall. And if we take a look at Wall Street expectations, this is considered a buy from 35 different analysts. There was 8 strong buys, 15 buys, and 12 holds. No one is selling out of Costco at this current point in time, and the average consensus on the street right now is a buy for the retail giant. So now we're going to wrap up the video. In this episode, we took a look at Nvidia and Costco, 2 of the companies mentioned as a buy from some of Wall Street's top analysts. We went over their current operations and took a look at their financial performance. I want to thank you for watching the video all the way to the end. Please hit that like button and subscribe if you already haven't done so, and I will see you in the next one. Thank you.